The once impregnable fortress of finance is showing cracks. Six colossal banks, household names synonymous with stability, are now teetering on the edge of a precipice. While not get swallowed by the abyss, their precarious footing sends shivers down the spine of the entire financial ecosystem. Number 6. Silicon Valley Bank. Icarus takes a tumble in rising rates. The Silicon Valley skyline, once shimmering with a mirage of endless growth, now reflects a stark reality. Silicon Valley Bank, SVB, the crown jewel of tech-fueled finance, lies in smoldering ruins. Icarus, fueled by optimism and cheap money, soared too close to the sun in unbridled lending, only to have its wings melt in the flames of rising interest rates. The March 2023 collapse reverberated through the valley, sending shockwaves of fear and uncertainty through tech startups and venture capitalists alike. SVB's downfall wasn't an overnight event. It was a slow-motion tragedy played out in boardrooms and spreadsheets. For years, the bank thrived on a model of aggressive lending, pouring billions into startups fueled by the frothy optimism of the tech bubble. These were high-risk ventures, their success tied to the fickle winds of innovation and investor sentiment. As long as money was cheap and plentiful, SVB could afford to gamble on the next big thing, its balance sheet ballooning with debt-backed dreams. But the tide turned in late 2022. Inflation reared its ugly head, prompting the Federal Reserve to raise interest rates. The once free-flowing capital spigot tightened, and the easy money party came to an abrupt end. Startups, suddenly facing a harsh reality of financial scrutiny, faltered. Valuations plummeted, IPO dreams evaporated, and loan defaults began to pile up. The foundation of SVB's house of cards, built on sandcastles of debt and investor hype, started to crumble. Number 5. First Republic Bank. The gilded cage crumbles under the weight of wealth. Across the Bay Area and the gilded enclaves of San Francisco and Los Angeles, another tremor resonated through the financial landscape. First Republic Bank, the exclusive playground of Silicon Valley's 1%, met its own dramatic demise in May 2023. Its fall wasn't a cataclysmic event, but a slow, agonizing unraveling, like a once majestic mansion succumbing to termites and neglect. First Republic's foundation was built on sand, albeit very expensive sand. It catered to the tech elite, those who surfed the digital wave to unimaginable wealth. Their fortunes, however, were often tied to volatile tech stocks and leveraged real estate, a precarious foundation for a financial institution. As the tech bubble burst and the housing market cooled, First Republic's clients, facing margin calls and declining asset values, started pulling their money out. But it wasn't just client withdrawals that brought First Republic to its knees. The bank, accustomed to the easy money days of endless capital inflows, had grown reliant on uninsured deposits. These fickle funds, unlike insured deposits guaranteed by the FDIC, could vanish at the first whiff of trouble. And trouble did come. As rumors of First Republic's exposure to shaky tech stocks and overvalued real estate spread, depositors panicked, causing a bank run that the bank simply couldn't withstand. Number 4. Signature Bank. When the crypto craze fizzles into financial fallout. Beyond the tech and luxury sectors, another tremor shook the financial landscape. The implosion of Signature Bank in March 2023. Unlike its fallen brethren, Signature's downfall wasn't due to rising interest rates or shaky real estate deals. It was a victim of a different kind of speculative mania, the cryptocurrency craze. Signature, lured by the siren song of digital gold, had become heavily invested in Bitcoin, Ethereum, and a constellation of other nascent cryptocurrencies. Its executives, drunk on the heady fumes of astronomical price rises and promises of decentralization, saw crypto as the future of finance, a revolutionary escape hatch from the shackles of traditional banking. They poured billions into crypto ventures, their balance sheet becoming a virtual casino floor where digital coins replaced chips and bets on blockchain replaced roulette spins. But, as with any speculative bubble, the crypto craze was destined to burst. In late 2022, the Erzak's tuo Akadzix Bolonu. Bitcoin, once soaring past $80,000, nosedived into the abyss, dragging the entire crypto market with it. Ethereum, the self-proclaimed world computer, sputtered and coughed, its once ambitious projects put on hold as valuations evaporated. Signature, its vaults suddenly brimming with devalued digital assets, faced a grim reality. Its gamble on the future had backfired spectacularly. By March 2023, the inevitable happened. Signature, its foundation built on a foundation of sandcastles sculpted from digital dust, collapsed. The fallout was swift and brutal. Investors across the crypto landscape, already reeling from the market crash, saw their losses multiply. Confidence in the entire ecosystem plunged, casting a long shadow over the nascent blockchain industry. Number 3. Western Alliance Bancorp. Cracks in the California dream. The tremors weren't confined to Silicon Valley or Wall Street. They reached across the sun-drenched plains of California, shaking the once solid ground beneath Western Alliance Bancorp. This regional bank, a pillar of coastal communities from San Diego to San Francisco, now faces a precarious future, its California dream facade showing cracks under the pressure of rising interest rates and a slowing economy. Western Alliance's troubles stem from its deep roots in high-cost coastal markets. For years, it thrived on catering to the affluent residents of California, offering them easy access to mortgages, home equity loans, and other credit products fueled by the seemingly endless appreciation of coastal real estate. This model worked like a charm during the long bull run, with rising property values ensuring loan repayments and generating handsome profits for the bank. But the tide has turned. Interest rates, once kept artificially low for years, have begun their inexorable climb. This has made borrowing more expensive, putting a damper on the once booming California housing market. Home values, long accustomed to defying gravity, have started to plateau and even decline in some areas. This threatens to trigger a wave of loan defaults as homeowners struggle to meet their mortgage payments with shrinking incomes and stagnant property values. Number 2. Intrust Financial Corporation. Uninsured deposits haunt the house of cards. While the tremors from Silicon Valley's tech titans and California's coastal dreams resonated loudly, a quieter yet equally unnerving rumble emanated from Intrust Financial Corp. This mid-sized bank, primarily serving rural communities in the Midwest, wasn't felled by flashy tech ventures or volatile crypto swings, but by a more fundamental weakness: its over-reliance on uninsured deposits. Intrust, like SVB before it, built its house of cards on a shaky foundation of trust. Unlike traditional banks, whose deposits are insured by the FDIC up to certain limits, Intrust relied heavily on non-federally insured funds. These deposits, primarily from local businesses and farmers, offer higher returns in exchange for the risk of not being protected by the government safety net. This strategy worked well in a stable economic climate, allowing Intrust to offer competitive rates and attract a loyal customer base. However, when the winds of economic uncertainty began to howl, those uninsured deposits became a ticking time bomb. Rising interest rates and slowing agricultural markets put a strain on local businesses and farmers, hindering their ability to make loan repayments. Fearful whispers about the bank's shaky financial footing spread like wildfire, and depositors, faced with the stark reality of losing their entire savings, rushed to withdraw their money. Number 1. UMB Financial Corporation. Rural roots facing urban woes. The tremors weren't confined to coastal enclaves and tech hubs. They rumbled deep into the heartland, reaching UMB Financial Corp., a bank with deep roots in rural America. While UMB hasn't faced the immediate threat of closure like its fallen brethren, its seemingly stable facade hides a growing unease about the challenges brewing in the agricultural sector. UMB prides itself on its long-standing relationships with farmers and agricultural businesses, providing them with financing for everything from planting seeds to buying equipment. This model thrived during years of bountiful harvests and rising commodity prices. However, the idyllic picture of Farmer John tending his fields with UMB's unwavering support is increasingly threatened by a confluence of external factors. Rising global inflation and trade disruptions have created a perfect storm for the agricultural sector. The cost of fertilizer, equipment, and fuel has skyrocketed, squeezing profit margins for farmers. The war in Ukraine further disrupts supply chains and casts a shadow of uncertainty over global food security. These headwinds threaten to trigger a wave of loan defaults as farmers struggle to meet their debt obligations in the face of declining earnings. These 6 banks are merely the canary in the coal mine, their struggles a symptom of a deeper malaise infecting the financial system. Rising interest rates, geopolitical tensions, and an economic outlook as murky as a swamp on a moonless night create a perfect storm for even the most formidable financial institutions. As we navigate this treacherous terrain, one thing is clear: the financial landscape is undergoing a seismic shift, and only those who adapt with the nimbleness of mountain goats will survive. These financial tremors are a clarion call, urging us to stay informed and keep our life jackets close. Subscribe to this channel for in-depth analyses, expert insights, and up-to-date reports on the ever-evolving financial landscape.